think that part of the drop really was that the market was overvalued before this whole thing happened. There were a lot of people who thought that, compared to historical values and how we measure them, the S&P was way, way, way up. And maybe this was just, gave a reason to sell off, but there is uncertainty and everybody's situation is different. If you've got good, steady income and you got a strong stomach, maybe the right thing to do is to do nothing. If you don't have steady income, then maybe you have to think about taking action. But what that action is really is going to be driven from person to person. So we'll throw it up for comments, questions, whatever.
Where's the other guy, Elliot? You go.
I don't know, it just came in.
Ratner, are you going to say something, or are you and your wife just chatting?
We're just chatting.
Okay, well.
No, we're overwhelmed with your presentation.
I'm sure you are. I'm going to hand it over to Mark Ratner, who's going to talk about the Israeli baseball.
Can anybody hear me? It's Mike Friedman.
Yeah, yes.
Yes. I'm not on video. You don't have to see me in my jammies.
Okay. Too much information. Okay, go ahead.
I would be very reluctant to start selling and book my losses unless I really needed the money. In my opinion, I would just hang in there because it will come back. How high it'll come back, that I couldn't tell you, and I don't think anybody else can. But if you got a portfolio where you're getting some yield, you got Social Security, you may have some bonds throwing off income. I know I just looked at my American Express bill, and it's nothing compared to what it used to be. Certainly, the restaurant tab is way down. I'm not using as much money as I used to, so I don't need the income that I used to. So I think that if people were to actually look at what they're spending and where they're spending it, they may be able to just sit tight and wait for this to come back. You're not forced to take your RMD. You've got a delay in paying the taxes. So those are my thoughts.
Yeah, and I think everybody, and that probably could be the right decision for you. And I think everybody's circumstances are different. Yes, if you've got good, steady income, and you're patient with the holdings that you have that have gone down in value, and you could ride it out and not lose sleep. And as I said, you have the income to get you through. Could very well be the right move. I mean, Elliot, generally, how do you feel about that?
Right. No, most of the time we will talk with our clients, and of course everyone is in the same position. But we're holding through this because if you're long-term in perspective, you will come through this and probably do very well. We had people who were buying 2-3 shares of a stock on the way down just to build a position because they can't tell where the bottom was. When we're now trying to protect against the downside of another pullback. There's always a second leg down, and that could be possibly coming. So this is where you want to evaluate whether or not you can hold your positions and stay in there. Long term, we'll be back. It will take a little while, but we'll be back.
Could you comment on not necessarily getting out of equities, but rebalancing? You know, if you're in certain sectors that have been successful over the past 6 months, 6 years, whatever, and you know the market's changed, and the winners and losers are going to be different based on everything that's happened because of the pandemic. Does it make sense to maybe cut your losses on certain stocks or funds, for that matter, or ETFs, and move them into different sectors?
From my standpoint, absolutely. The rotations that we're doing right now are coming out of some of the weaker sectors. Your energy exposure should be down to very little. If you come to me and say, let's start buying the energy sector, you're probably going to be a lot premature. But the engines of what the growth of the economy was the technology sector, the financial sector, which kept that up as far as the financials and the money, the value of money, definitely would keep positions in those areas. What we're finding within our systems, and actually in Fidelity, they're actually dropping the entire customer service department, and it's going to all tech. So if you want to request a check, for example, it's just a matter of push a button, where we used to have to go through before. So I think that's going to happen in all industries where the workforce is going to change. So I would stay heavy into the tech sector and make that rotation without a doubt, and get into more of the indexes as a protective device.
How about the medical sector and healthcare and all those as well?
Right. We do like the health, Fidelity likes the healthcare sector and the medical supply sector. Yes, they're definitely there, but overweighting, I'm not sure how much of a percentage. It depends on how much the individual would want to know, but yeah, we would be in that too. Healthcare, the four majors are the financials, the healthcare, the industrials, and the technology sectors.
Thank you.
I have a question. Marshall Gates, can you hear me?
Yes, sir.
Okay. Now, if you have cash, a certain amount of cash that you don't really need to spend now, but it's simply cash rather than a specific other stock or fund, do you think it's worth holding the cash or putting it into some kind of a well-managed fund in one of the sectors that you just mentioned?
Well, I think that first off, you always want to make sure you have cash, an emergency fund. You're never going to be 100% sure what's going to happen. If, however, this is cash way above what you could conceivably need over the next several years, then maybe you want to. Personally, I don't think I would be jumping in head first all at once. You might want to do it over time. But, at a time like this, having some cash is not so terrible. So.
All right.
Especially when you expect a second leg down. And if history is on your side, you will get that second leg. It seems to be a good amount of events now are starting to lead up to the weakness that everyone is looking for. The production isn't there. People aren't going back to work fast enough. As you roll open the economy, it's not going to be as fast as you want it. And the stocks will be punished. There's no doubt. How deep will it go? Can't tell you that.
Elliot and Mark, could you comment on protection of cash in the brokerage accounts, and for those that have cash in money markets or other highly liquid funds, basically talk about how to protect the cash if there is a systemic issue?
Stay in mutual funds, stay in the cash accounts. There's no pressure to come out. I agree with Mark, definitely to keep the emergency fund. We're building cash now in some of the more risk-averse accounts that we talked through the first downplay, but now we're getting more fear and more calls.
Hey, Bruce, are you talking about a concern about these funds, breaking the dollar, basically, and
in mid-March, when I've got the actual date of when spreads of munis were basically 10, we're running about 8 to 10% between the buy and sell ask, and that we had there were concerns with the liquidity and number of the funds that we had, so we moved it to cash. But on the other hand, if the cash is sitting at the brokerage house in either a protected bank account or if it's sitting in the house account, you don't want necessarily the cash to be at risk if there was a problem with your brokerage firm.
And so you're concerned about the brokerage firm. Well, look, if you're really, really, really concerned, then basically take it out, just put it in CDs. And then maybe you'll sleep better. I generally think that it's pretty obvious that the government and the Fed has decided that they're not going to allow there to be any kind of liquidity event. They've just totally opened up the floodgates with money. And the last thing they're looking for is a crisis like that. That being said, the safest investment still is anything that's insured by the U.S. government. So, buy short-term treasuries. If you're
Mark.
nervous.
Hello, Mark. Can you hear me?
Yeah.
Hi, Mark. It's Michael. So you are correct. The government has come out with these massive stimulus programs, in the trillions of dollars. It's kind of staggering, and they are distributing funds very rapidly. I've heard that the question came up: where is the federal government coming up with all of this money to distribute? And I think Mnuchin said, "Well, we're just printing it. We're just printing money," which I'm not sure what that means or if it's true or not. But is there any concern that you might have with all of this, additional money flooding into the market, that it could lead to an inflationary environment where instead of seeing interest rates, in very low numbers, we could enter in a situation where inflation starts to run rampant, as a result of all the additional influx of money?
Logic tells you that we would have an inflationary concern. Logic tells us that we should have had an inflationary concern 3 years ago, or 2 years ago, or 1 year ago. It's a total conundrum. Nobody understands how we can, be able to borrow so much money and still manage not to have inflation. One explanation I've heard, I don't know whether it makes sense or not, is that while we may be borrowing tons of money, as long as the US dollar is the go-to currency in the world, we're in a strong position because we could, to some extent, control how high interest rates are going to be. If, however, there are other alternatives to the US dollar for debt investments, then there could be concerns. It's another unknown. Yeah, who would think that we'd be with a debt of, what is it now, $25 trillion so quickly?
Sure.
Ratner, stop talking to your wife. Every time you talk, I see his name go up.
It's one of the rare times.
Does anybody seriously think that Russia or China or any other country, or even a European country, their dollar is going to become the go-to dollar? I can't even foresee that happening. Even the Saudi, whatever their money, reals or whatever it is. At this point in time, who's going to replace the dollar?
Doesn't seem like there's any strong contenders. I think the one thing we've learned, Bud, is that we could never be sure of stuff. Who would have thought a lot of things, these, what do they call them? These black swan events. They can occur. You're not going to know what they are. You're not going to know the impact. Our job basically is, as an investor, your job is to try to think about risk, try to think about stuff that could go wrong. How do you deal with that? Well, you deal with that by having some cash. You deal with that with the rest of your investments to be highly diversified, as opposed to putting all your eggs in one basket. you know, you try to limit any debt that is not absolutely necessary. You know, you try to think through, hey, what would happen if something, you know, if the market crashed? And, you know, the way you deal with that is making sure that you have steady income, or you have money that's invested in a pretty safe place. Nobody here can really predict that our currency is going to be the only real go-to currency 5 or 10 years from now. It seems likely that it will be. Who thought, you know, a lot of things have happened. So,
You guys comment, thinking outside the box a little bit about real estate as an investment vehicle at this point in time?
I know nothing about it, but I'll tell you this much: I can't imagine like commercial real estate will be so great. I mean, more people are going to be shopping online. You know, this once again goes to the fact of how will people change their habits, their behavior habits? Are less people going to want to go out and mingle? Will more people be buying online? What's the impact on retail? What's the impact on, you know, shopping malls? I think a lot of shopping malls are in serious trouble now. You know, residential real estate, you know, from what I've read, you know, the builders have pretty much stopped building. There is going to be a supply shortage at some point. But are people going to be running out to buy homes?
What about medical REITs? People aren't giving up their doctors, and they have to have a building to practice in.
Nobody really knows where medicine is going to go. I mean, we could end up with a, you know, much more centralized government medicine. I don't know. I don't know much about them. Ellie, do you know anything about medical?
No, I haven't seen them come across, but going back to Don's question with the real estate, it's an asset class that you should have in your portfolio. The alternative is the alternatives that are coming in are high yield residential mortgages, and they're coming in quite strong as far as, you know, products to sell. I see them more in the commission side, but the yields are anywhere from 10 to 15%, and the deals are 3 to 4 years in duration. And if they follow the same cycle that I saw back in the 80s, when there was an explosion of ownership into real estate deals, the ultimate consumer gets hurt the worst over a period of time. And it is something that I would, if you don't control that asset, then don't go near it. That's what I recommend you. They will entice you with a very good yield, no doubt about it.
I'd like to say something about the medical. I think probably we're beginning to see telemed and examinations and visits by telemed. And I wonder if that's going to continue.
It could be a welcome area that would definitely impact. Everyone's more concerned about the medical area than ever before right now. Every day there's another good stock of explosion where they have a couple of good trials and the stock moves up 10, 15 points on a stock basis. And it would be a good area to be in, medical.
I have a question about, or looking for some comments about, you know, I don't want to get into a whole discussion, obviously, about our political environment here in the United States, but there's a lot of uncertainty, of course, of how we're supposed to approach attacking the virus. It was just yesterday that the mayor of Las Vegas, you know, was clearly in favor of just opening up all the casinos, which attract international travelers and hotels, who then, after they lose all their money in Las Vegas, are going to go back to their homes, and which are all over the country and all over the world. But I guess my question is, that's not the case in every country. And are you seeing any difference in the the markets and the way, you know, for example, Germany's had a very rigorous, everybody on the same page type of approach to attacking the virus. Are their economies likely to rebound any quicker, or just by virtue of the fact that there's a unified, approach to how to, on how to get the economies rebounding.
I don't follow those, but what somebody might do if they wanted to look into this is probably compare Norway and Sweden. Apparently, they took very, very different approaches. Sweden sort of like from the beginning said, hey, let the virus work its way through, but we're not going to have, lockdowns, mandatory kind of stuff. Norway did the total opposite. And of course, we know the death rates per capita are much higher in Sweden than they are in Norway. I do not know how the stock markets have responded, but somebody might take a look at those two and see if there's any information there. Elliot, do you have any ideas in this question?
The developed markets haven't really outperformed the United States. They were leaning heavily on our economy prior to March, I think it was March 7th or 8th when it hit hard. So, and Fidelity mentions that in the little brochure that we went through. I didn't get into it deeply, but the developed markets are impacted by us. So they're looking towards us as far as the motivator of the growth cycle. And as long as, without getting into politics, trying to stay away from that desperately. But the bottom line is they rely on us now. And the movement of industry that was coming back to the country here was impacting their economies and their issues. So I think they're looking at us, and they're in place at the moment. They're not going to outperform us, that's for sure.
So reading into that, just to follow up, I'm sorry to cut somebody off, but just the follow-up question was, I guess, we shouldn't, what I'm reading into what you're observing is we shouldn't take too much of a knee-jerk reaction if Georgia, the state of Georgia, wants to open up their economy prematurely, or that's built into the markets already. I'm surmising.
Right. As we unroll the states and you see what their issues are, what they're looking for is the second surge of disease-related incidences. And we're never going to know until we do it. There are so many people who say they've already had the disease and they were able to come out of it and be systemic at this point. So yeah, let's roll out and see what happens. They're very different. And the states that you have are Tennessee and Utah and Georgia, Alaska, isolated areas. But it may give us a blueprint. Yeah, I agree with Las Vegas opening up and trying to bring back their economies as fast as possible. And then you have we happen to be in the most battered area in the country. So we're very sensitive to what's going on, and our governors have got us locked down to an extended period of time. So let's see how it works out.
Has anybody heard or gotten any feedback from some of your sources about production coming back to this country and out of China?
Well, I can comment on that. We're getting a lot of that from Goldman Sachs and from Bear Stearns, not Bear Stearns, I'm sorry, from Morgan Stanley, that there is a drive to start to bring back those companies, and Trump is really going to direct his attention to that. So I suspect it's going to happen. And the tariffs that were in place, whether or not they continue to agree to utilize them, there's only one world and we have to live with this. So let's see how he can maneuver through that. But they're going to start bringing back, especially the production of medical compounds. That's where it's been, big exposure, as you're talking about, Michael. So yeah, I would start to see the momentum building as much as you can see that.
That's a good thing.
Yeah. See, the Chinese were on an international buy of real estate as much as possible. They went through us several years ago. They were in the tourist areas down in the Bahamas. They were half the country. There's an article that came out just recently that China had started to buy in Italy and took over the Italian country, and half the problems that they have experienced is because of the Chinese impact on they own half the country now. So that's why the doors were open between China and Italy, and why Italy got hit so hard. Because the story that's floating around, which everyone's hearing now, is China, the town, what was it called? Wu, whatever the name of it was. Yeah, they shut it down, and the only place you can get out of China was to in Italy. So that's why Italy got destroyed, and their percentage of deaths is tremendously higher than any place else in the world. So yeah, I think you're going to see that kickback and countries coming, and we've been discussing that in our strategy meetings and what to do, which is why we continue to buy. The high net worths are buying blue chips with good dividends. They will make it through this, whether or not you think how you feel the blanket is over your portfolio, but the big companies will make it through this. So pick the big blue stocks, and instead of sitting in money markets, keep your emergency fund there, but the balance of those funds should be into large cap growth or large cap blends, which is where the defensive areas are right now.
One of the, I guess, one of the concerns with manufacturing coming back to the United States, which is obviously a positive thing, is really what the impact is going to be on the cost of goods.
Mm-hmm.
And, we are so accustomed to cheap stuff. And, what are the ramifications going to be to the average wage earner when everything maybe costs another 20 or 30%?
And there's inflation.
Yeah, it's just so difficult to predict.
Right. As long as you have a supply sider in there that has some concerns about that, then we have a chance. But yeah, the inflation story is definitely going to be out there. I would say maybe before this happened, I was really looking at it maybe into the early part of 2021. So now it's definitely going to be impacted next year somehow. We'll start to see it rise.
Sounds like we'll run out of questions. And we've run out of answers. That's one of the problems.
We never had an answer.
Yeah. Uncertainty.
On the bringing the production back, the model has always been you have a lot of workers on an assembly line, you don't pay them, and cost of wages for that kind of work has always been much higher in recent years here compared to overseas, especially in Asia. The fact that so much has become automated, does that change that model? And bringing production back here gives us, certainly good internal control on quality and all that, but will the cost of goods go up under current circumstances for production versus 10, 20 years ago?
I think that's an excellent question.
I don't know if anybody has an answer.
Yeah, I would fully expect technology to really be a strong part of that answer, because a lot of people aren't going to be working for jobs now. I mean, customer service areas, service companies. I think more and more you're going to see it. You're always going to have your restaurants, and you're going to need that kind of labor force. But
that was never outsourced.
Right, right.
You know, talking about, we're bringing in masks and medicines from China still because that's the way we've been doing business. If we bring that back,
Right.
and especially the pharmaceuticals become very much of an automated industry rather than people on a production line, and quality is maintained, costs go down, we have good quality, and it's internal. We don't have shipping costs to deal with between China and the US. So the
And we don't
supply
have-
chain becomes simpler.
And we don't have jobs.
Right. There have to be other jobs, but we don't have the jobs in the first place if the production's overseas. So you're not losing jobs.
But in general, the whole idea of more technology, of more artificial intelligence, of more, automated production, and it's a whole different question, is going to have some long-term consequences.
The service industry, like restaurants and so on, rely heavily on the human factor, which cannot be replaced, cannot be automated.
I'm not sure that can't be automated.
Well, it can be, but people like to be serviced. Look how many times companies advertise, especially tech companies. We have US-based customer service people on the other end of the phone. Yeah, the implication being that you don't have to call somebody overseas who doesn't have good command of the language and gives you just a pat answer. So, if we're providing that human factor, I look to what happened when video recording, VHS, and all the home video recorders came out. They said that's the end of movie theaters. Well, it wasn't the end of movie theaters because people still had a human need to get out and do something socially. And I think it's the same with restaurants, and I think it's the same with a lot of the service factors that provided that you still need that human touch. We're all waiting to get back to Temple so we can all see each other. So, as good as Zoom is, it'd be great to have these kinds of conversations in person with each other.
I think people of our generation probably feel very strongly about that human touch. I'm not 100% sure that younger generations need it and feel as strongly about it as we do.
Don,
Sorry.
That's a very valid comment. Younger people have a completely different social thing than we do.
In regard to the restaurants, it depends on the actual asset class of the restaurants, because you can go to Chick-fil-A or McDonald's has been working with taking the counter out of the loop. And they've been working with either apps or actually touch screens in their restaurants. So it just depends on whether or not you're a high-end restaurant or whether or not you're in that QSR, that quick serve category.
I agree.
So you'll see.
Yeah, there's going to be disruption. The input, how great that disruption is going to be, who knows? But I mean, have a conversation with a 25 or 30-year-old. They look at the world very differently than we do, and they're eventually going to control it, unfortunately.
In terms of financial planning, most of the plans that we've all put together in the last 2 or 3 years have to be really looked at again, because the projections are a little bit off at this point. But it wouldn't be so fast to do that until this cycle runs its course and be able to see what's going on. Don't react. Don't overreact to this just yet.
You had mentioned U-shaped or V-shaped. It sounds like it's more like W-shaped.
Well, in all likelihood, it'll be, but I think and you throw out the W too. Right now, we're in the middle of the W. So that's why. Where are we going to go next? That's the question. It's hard to say.
I mean, we've actually come back halfway from the lows, I believe.
Right. We fell 30 and 33%, and now we're down only 20. And if you were positioned well, your accounts only went down maybe 15 to 20%. So when they give you these numbers, it's one asset class really heavily weighted. If you were in the index funds, you didn't go down that fast. You didn't. You actually buffered. We're actually pretty well buffered. And then when you talk about the spreads, Bruce, on the fixed income side, yeah, that we've been through the wild, and then the Fed flooding the markets the way they did just drove the interest rates way down. So this is artificial at the moment. We'll see what happens.
Elliot, the Fed's done a wonderful job. That day that I was talking about, there was real starting to be blood in the water. O'Neill, the Fed just jumped in at a big time and just threw everything they had at it.
Right.
Yep.
Right. That was the key.
We were told at that point that if you were able to buy funds that were to protect your cash, to put it in funds that were backed by short-term U.S. Treasuries and notes, that would have been probably your strongest protection.
Mm-hmm.
Now we have this other big issue hanging over us, and that is how are states going to financially navigate through this? States they're supposed to have balanced budgets. How does New York, that all of a sudden now is going to lose tons of tax revenue, has all these different additional expenses? How are they going to get through this? They have to cut jobs. They're going to have to cut services. That's going to drive unemployment lower.
Mark, think about if McConnell has his way, McConnell has what he desires or recommended that the states be able to go to use bankruptcy laws. What would that mean to the pensioners?
Oh yeah, it would be, be total havoc. I mean, so I'm shocked that the market is where it is, personally, when you think about all of these uncertainties. But I guess, people are feel that, enough people feel that it's properly priced. It's difficult to understand.
It's also Tina, right? There's not any better place to go.
Right.
It's interesting times.
Right.
You were talking about budget deficits before and the impacts, and I've read, and I sat down with a senior research guy at one of the big banks, and they were doing studies about what percentage of GDP national debt gets up to. It's a problem. My big takeaway is that as we grow the national deficit relative to GDP, it becomes a problem, not necessarily this year, 5 years from now, but they're basically saying our kids are going to be saddled with issues down the line in 10 years plus, in 10, 15 years plus.
Mm-hmm. Mm-hmm.
And this is one of the guys who worked with Michael Costin at Goldman Sachs.
Keep kicking the can down the road.
Yeah. And then we have the Social Security Trust Fund that is going to run dry in 2035. Something's going to have to be done there. They're too risky to allow people not to get the benefits that they were expecting. So that's going to cost even more money.
Thank God for the printing press.
And really, it is so hard to know what the long-term implications are of all this government borrowing. Right now, it appears no political party has any interest at all, almost under any circumstances, never mind under these dire circumstances, of being concerned about deficits.
How do you sell that to a voter?
Yeah.
I don't think the voter's that concerned. The voter's only concerned about their own individual assets right now, their income. If you tell them there's going to be a deficit to pay Social Security, you think anyone's going to complain? Any senior is going to say, well, I'll give up my Social Security so we don't have debt. That's not going to happen.
So that clearly on a long-term basis, debt is a concern. How long-term that is, who knows? What the implications are, who knows? There's no playbook for this.
We are in uncharted waters.
So,
Hey, I think we're getting towards the end.
so people are going to sue China because of this and get paid in worthless yen? That doesn't seem possible either.
Can I bring it back to the states and the terrible financial situation they're in? What does that bode for munis, general obligation bonds?
Well, the insuring agencies, most of them, first of all, the muni bonds are now being called left and right.
Yes.
And they're, you know, the 5%ers you had are now gone.
Forget that, yeah.
Yeah, and all the packaged products are starting to show cracks in the dividends that they're putting through. It's going to come. It's going to come. I mean, the backing of those bonds it's getting weaker and weaker. So that's why the munis were the best place to be in the last several years as an asset class. So yeah, God knows what's going to happen with this, especially the states that are in trouble. And yet we're getting new issues every day. It's crazy, but we're getting new issues every day. The yields are, you know, the 30-year papers, the yield is 2.5%. Tax-free.
Well, why wouldn't we get new issues? They need money.
Right. Right. And there's a tremendous amount of wealth out there. You know, we look within our little world here, but there is so much wealth out there, and again, most of them are in the barbell arrangement. They're the muni bond side, and then they're in the blue chip S&P with good dividend yield.
You know, I think that there are a lot of the state munis were dangerous to be in anyway. I mean, if they had a defined benefit pension plan, you had to be really, really careful to understand what the true liabilities of that plan are, because they are usually way, way, way understated, using assumptions that are not realistic. I had, you know, as an actuary, I had been asked to look over New Jersey's funded status several years ago, and the assumptions that were being used were absolutely ridiculous. I mean, to the point of understating liabilities by a factor of half. It was, and this is true of many states with defined benefit plans.
It's interesting. That's a really interesting comment, Mark. Ellie, could you expand on where you were seeing cracks in the muni markets that you said a few minutes ago?
In the lower yields, in the lower quality rated bonds. You know, the high yield market now is very suspect. I would never go near it. In the muni market, in the AAAs, the yield is so ridiculous that you might as well go out and buy yourself a good quality, you know, stock or equity that would pay you a good dividend and chance for appreciation. Again, these companies aren't going anywhere. So if you look at the 3M, Caterpillar, you know, those kinds of stocks with the yields, you know, God forbid a Boeing should take place again. And that is now one of the biggest discussions, whether or not you would want to put money into Boeing kind of a deal. But blue chip, high quality, and make sure your income stream is meeting your life expectancy, and that's it. Go off and have a good time, because all of this is going to go on no matter what happens. I expect a Korean type of brawl in the United States Senate soon, you know, one of those deals.
Yeah, but watching Parliament's so much better.
Yeah, right.
Okay, Okay, well, I'm going to jump on and thank Mark and Elliot and all of you for participating. Our time is coming soon, and I don't want the call to end before I said thank you to everybody.
Thank
I
you.
don't know if
Thank
we
you.
just end the
Thank
call
you.
or if I had to end the call. So thank you all. Shabbat Shalom. I hope you're all safe and healthy. And again, thank you to Mark and Elliot for hosting.
Thank you, Mark and
today.
Elliot.
Thank you, guys.
I
Thank
think
you.
it went
Helpful.
very
Very
well,
much.
and I look forward to us doing more of these in the coming weeks. So
Thank you, Jen.
take care, everybody.
Thank you.
Jen,
Take care, everybody.
everybody.
Bye-bye. Thank you. Have a good
Bye.
weekend.